This is how the underworld cashes out undocumented crypto with no trace, all through private equity. It's not just done by street-level criminals. The richest of the rich use it too. Take Donald Trump's meme coin. Just recently, a shady Chinese private equity fund pledged $300 million to buy up his pump and dump scheme. And guess what? All of those millions, they'll be quietly moved into clean, traditional banks, no questions asked. And today, I'll show you, crypto bros, how you too can use the same exact structure to cash out your crypto with no paper trail, no source of funds documentation, as well as protect your newfounded wealth. And no, it does not cost hundreds of thousands to set one up. You'll learn in the next few minutes all of the moving parts you need to plow your crypto, Bitcoin, Monero, Ethereum, all straight into a bank account, real estate, or whatever crazy thing you're looking to buy. With that out of the way, let's dive in. The reason why you, Mr. Rich Crypto Bro, keep getting flagged by banks, and Trump does not, isn't just because he's president. It's because the wealthy know how to present their money in a way that banks can safely accept. See, there's this massive misconception. Banks, they don't morally care about where your money came from, HSBC. They care about two things. One, they obviously want to make a profit off of your cash, and two, they don't want to get caught. And since daddy government is constantly breathing down their necks, the moment that you plow all of your crypto from a centralized exchange straight into a bank account with no source of funds, the bank panics. They have zero plausible deniability to show regulators that they did AML checks, that they did their jobs. It all looks shady and they simply don't want to deal with you. That's why the wealthy, they package their money through sophisticated structures like private equity, because it gives the bank a backstory to say, well, we did our due diligence, all the documents were in order, and on surface it looks legit. Even if that is not the full truth, this structure makes it seem true, and that reduces the pressure for the bank. Now, even though private equity sounds fancy, it's actually not that hard to set up, nor that expensive if you know what you're doing. And we're going to get into how to build this structure later down in the video, but first, here's a quick explainer in simple English on what it actually entails. It's basically a legal setup where a group of people pull in their money, in this case your crypto, into a company that will buy that real estate, businesses, startups, pretty much whatever. Now, the person who decides how the money is being used and invested is called the general partner, and depending on how you build up this setup, the investors, aka the limited partners, can stay invisible. Most importantly, if done right, banks actually like working with these type of setups, especially when moving large amounts of money internationally. Now, there are two main reasons why it's such an effective tool to cash out your crypto and unfortunately abused by criminals. One is the fund's rulebook, and two is compartmentalization. Now, the rulebook is pretty much the harpoon of any private equity fund because you get to decide upon the rules. You get to choose whether or not you accept contributions in crypto instead of regular fiat. You get to choose whether you have offshore investors, which adds anonymity. And you also get to choose when and how the investors get their money back. And also, because these funds are designed to make money and reduce risk, it's naturally going to be compartmentalized because if one investment goes bad, you don't want the entire fund to be dragged down with it. And this gives a plausible explanation to banks as to why there are multiple entities, why you're working through offshore jurisdictions for tax optimization, why you have intermediaries and a bit more complexity. We'll get into the finer details in just a minute, but first, here's the bigger picture. Your private equity fund is going to have two main companies. And the first one is called the holding company. Think of it like a vault that's going to keep all the pulled in money securely and cleanly. It's not the one that's actually going to do the investments. For that, it's going to own an operating company. And that's where you're going to put in the risky, aggressive investments into startups, businesses, real estate. And the reason you want to have this separation is because if regulators or creditors ever come for that holding company, guess what? it's not the one with the actual money. The money is in a different jurisdiction with a different entity completely outside of their reach. So, how do you move your crypto, the same coins that no bank wanted to touch, into the private equity fund and cash it out cleanly? It all starts with layering. You're going to start off by forming a bunch of cheap offshore companies. They're going to be your limited partners. They're the ones that will invest the crypto into the fund. Now, this is one of those interesting scenarios where you can actually use those classic tax haven jurisdictions, the cheap Caribbean companies with nominee shareholders, because you do not need them to access bank accounts. They simply are going to hold the crypto on their balance sheets. You think of them as legal placeholders that are going to quietly feed the fund with crypto. But when you're moving those coins into the private equity setup, you want to make sure that the fund never actually holds the crypto directly. Do not make that mistake, because that could trigger the need for you to get a crypto license, whether a virtual asset service provider license or a money service business license, depending on the jurisdiction that you're operating in. So the smarter approach is to work through payment processors. They're going to be the ones who will convert that crypto into fiat before it hits the fund's bank accounts, and essentially you're dealing with a fiat bank wire transfer. To do it right, you would need a special purpose vehicle, or SPV. Now, it sounds like complex legalese. It's actually quite simple. It's basically a throwaway company that was designed with one purpose in mind, in this case, to convert the crypto into cash by connecting itself to the payment processor, and once the job is done, you can pretty much forget about it. An easy analogy to explain it to you would be, imagine a mob boss doesn't want to use their own made guys for a hit so that they wouldn't get in trouble. So instead he would hire a contractor, pay them for the job, and then they both separate. If the cops ever come knocking on the door, technically speaking, the mob can say that they had nothing to do with it on paper. Of course, this isn't an apples to apples comparison, but you get the point. That the SPV allows the fund to be clean from a regulatory standpoint because the private equity never touches crypto in the first place. With the general structure in mind, that's where you can integrate additional add-ons depending on how anonymous you want the fund to be. Now, a popular play that many wealthy people use is not to outright own the shares in the operating company. Instead, a trust owns them. It's the classic own nothing, control everything adage. And through carefully crafted agreements, you can still be the one that manages the investments. But don't get sloppy, because you need to show that the trustee isn't just rubber stamping all the decisions. It needs to have independent oversight. Otherwise, it's just going to be a sham trust. It's going to be pierced by all the courts. And what that means is to have an actual paper trail where you're giving constant updates to the trustee. It supervises, manages your performance, does check-ins, even if they're just formal, but it has to be well shown that there is a separation between you and the money. And by the way, when distributions happen, they happen on the trustee's terms, not yours. So sure, as an investment manager, you can absolutely receive a performance-based salary or an investment management fee based on how well you've done. By the way, it's not just a great way to get paid, it's also great as a creative accounting tool to reduce your taxes as well as shift money between those entities. But the point I'm trying to make is that you want to use this private equity setup in order to make it seem like you, as the general partner, don't own anything. You're just the manager. You're not going to invest as a single investor. You're going to use those secrecy laws for the limited partners to once again make it seem like they are the ones bringing in the money. And that also allows you to use a lot of creative accounting strategies in order to reduce your tax burden. For example, it gives a great reason for you to give out loans to the startups that you're investing in. And if they ever become successful, you can use those profits to pay down the debt, thus reducing your tax bill. You can set up companies for things like royalties or intellectual property and then license them out to those main investments. Or even the investors can loan out the money to those initial holding companies, which will later on buy the shares in the fund. And that lets them control how the money is brought back, usually tax optimized. Now, when it comes to choosing the jurisdiction for your fund, specifically the holding company, always keep the end goal in mind. And what I mean by that is tax optimization. It's great, sure, but you want to have a functioning bank account to off-ramp your crypto into. And that means before you set up any companies, always ask the banks which jurisdictions they would actually onboard. What are their licensing requirements? Because, for example, the Cayman Islands is a very popular destination. Obviously zero tax, they have good secrecy laws for the investors. However, because it's a tax haven, you usually need to have a professional setup to make it work, which means professional fund administrators, a SEMA license, which, by the way, can all be done. It's just going to cost you more. It's going to be $20,000 roughly upfront and $10,000 per year in maintenance. It allows you to charge a management fee, and it's more flexible when it comes to receiving the investor funds. But that's a decision that you would have to make. For larger sums, most crypto private equities are structured in first-tier jurisdictions, for example, Canada, where the Ontario LLP legally does not require the limited partners to be disclosed. Only the general partner has to appear in public records, so your investors could stay hidden. And also, in order not to get licensed, you can deal with only accredited investors that invest a minimum amount, a threshold. So if you would have over 7 figures in crypto, each crypto investor would have about $250,000 that they would invest, and you would qualify. More importantly, the Canadian LLP is a pass-through entity, which means that the investors pay the tax on the personal level, not the company itself. So if you're residing in a tax-friendly jurisdiction, you can legally reduce the taxes to almost, if not 0%. It's actually more popular now than the United States after the Corporate Transparency Act. Even though it's not being enforced, Canada does not require the limited partners to be reported to their financial watchdog FinTrack, unlike the US, which in a few months, if not a year, it's going to all be reported to theirs, FinCEN. For the operating company, it all depends on where you're investing and how you want to move the money back to yourself, back to the investors to pay out dividends eventually. So you want to tailor it to the holding company's jurisdiction, but also to your home country's tax residency, because that allows you to take advantage of the double tax avoidance treaties, and it should make sense on paper why you're setting it up that way. So if you're investing in the Middle East, then a UAE company would make sense. If you want better access to banking or European investments, Estonia is a very good jurisdiction. By the way, they even allow legal silent partnership agreements for extra anonymity. You can also go for Andorra for good banking. And if you want aggressive off-ramping, then the country of Georgia could be an option. They have zones for tech companies where you can even get 0% taxes for startups as long as they do not give services to both Georgian residents or citizens. Now, managing your own private equity fund is not designed for you to just sit on your wealth. It's meant for you to actually grow that crypto once it's been off-ramped and, of course, getting good access to banking. So if this all sounds too overwhelming or you think you're going to get a headache from doing all this, don't build it yourself. Use already pre-existing private equity structures and basically off-ramp your crypto through them. Get that source of funds documentation as well as that access to good banks. By the way, they exist all across the world. Granted, these structures aren't going to be publicized online or in some law firm. In fact, if you didn't know that they accepted crypto, it wouldn't look like anything much from the outside looking in. You would need an actual introducer, a lawyer, somebody who has already interacted with the fund in order to buy shares, but it's doable. Another option, if you don't have the 7 figures, is partner up with your friends or close associates and pool your money together to build one. By the way, that's what a private equity fund is designed to do. And with all the crypto regulations coming in, CARF, DAC8, we believe that this is going to be the main off-ramping mechanism over the next few years because of all the surveillance. I made a previous video that gives a brief outline on what private equity is from a bird's eye view. You can check that out over there, but that's it for today's presentation. If you enjoy this video, you can share it with a friend or you can comment down below. I'll be seeing you though next time, and until then, bye-bye.